Hi, I'm James Rotolo, the Principal for Insurance Fraud Solutions at SAS. Today, I'm going to talk about the value of using a hybrid approach for insurance fraud detection. Losses due to insurance fraud are on the rise. Increasing economic pressures and a growing wave of organized fraud rings make fraud detection a top priority for insurance companies worldwide. Traditionally, insurers have relied upon claim adjusters to manually identify red flags to detect fraud. More advanced companies have automated this process or implemented predictive models to detect suspicious claims. For most organizations, however, current fraud detection methods are fraught with manual procedures, large numbers of false positives, and a failure to integrate siloed data from business units or incorporate unstructured text data. The key to effective fraud mitigation is combining detection methods that leverage data points from across the enterprise and constantly add new intelligence back into the system. At SAS, we've incorporated this concept into our fraud framework solution with a hybrid approach to insurance fraud detection. Most insurers have information silos populated by various transactional systems. For example, an insurance company may have data on policies, claims, and vendor payments. Other sources like human resources systems or external third-party data could also be used. With a framework-based approach, the data from each of these systems is aggregated into an intelligent data repository. It's important to note that unstructured text data needs to be included here. Some studies suggest that upwards of 80% of insurer data is in a text format. In our experience at SAS, anywhere from 1/3 to 1/2 of the components in a good insurance fraud detection solution are based on unstructured sources, like claim notes or customer service logs. With all the information aggregated, claims are scored using a combination of technologies. First, business rules can be used to flag certain behaviors. For example, a business rule could flag any claim filed within 30 days of policy inception, a common indicator that more detailed claim review may be required. Next, anomaly detection is used to reveal abnormal patterns of activity compared to a peer group. With all the data aggregated in the intelligent data repository, this type of analysis is now easy to conduct. For example, anomaly detection might flag a claim with a high ratio of bodily injury exposure compared to the physical damage sustained in an auto accident. This can be an indicator of staged accident activity. Then, predictive models can be used to identify complex fraud patterns. For example, a predictive model might identify suspicious accident indicators based on prior investigative experience that would have otherwise been difficult or impossible to detect. Finally, social network analysis is used to identify organized ring activity. Networks are built automatically based on connections made within the data. These connections often go unnoticed by adjusters who typically don't have the luxury of analyzing data in this fashion. For SAS customers, this has shown results up to 10 times more fraud detected and $50 million in annual benefit to Tier 1 insurers. While each of these detection systems is independently powerful, the real value of a framework approach is demonstrated by this next step. All of these components work in concert and are managed by an alert generation process, or AGP. The AGP is what generates a fraud risk score for each claim. But instead of relying simply on the details about a single claim, the framework is able to evaluate other claims in the same peer group or within the same network, and influence the fraud risk score accordingly. Let's look at an example. If a claim is flagged by a business rule, it might get a moderate risk score. But if other claims within the same network, say involving the same participants, also trigger fraud business rules, the fraud risk score for that claim would be increased. The fraud risk score and relevant information about the claim is then transferred to an enterprise case management system, which can be used by a special investigation unit to review alerts and track the progress of investigations. A case management system should house all investigative information, including notes, evidence, and investigation outcomes. This type of consolidation has been shown to improve investigator efficiency by more than 25%. The information from the enterprise case management system then becomes a new source for the intelligent data repository. As investigations are conducted, the system learns about fraud patterns and suspicious entities and can use that information to improve the alert generation process for future claims. Good fraud mitigation capability reduces loss costs and should be part of every insurer's claim management strategy. A hybrid approach to insurance fraud detection reduces false positives, uncovers both opportunistic and organized fraud activity, and improves the effectiveness of a special investigation unit. To learn more about the SAS fraud framework for insurance, go to sas.com/insurancefraud. I'm James Rotolo, the Principal for Insurance Fraud Solutions at SAS. Thanks for watching.